Welcome to Market Monday from the investment team and the trust department at the First National Bank. We're going to start today, like we typically do, with a review of the economic numbers over the next couple of weeks and in events as well. We'll talk about equity indexes, we'll talk about treasury rates and corporate bond rates, and we'll discuss the investment implications of this memorandum of understanding that was reached over the weekend and signed in Switzerland between the United States and Iran. So let's jump right in. We just got some information on manufacturing, and it wasn't great. It suggests, this empire manufacturing and the industrial production and so forth. These numbers suggest that the economy may be decelerating in its growth. Not, going negative, not declining, but certainly decelerating from prior month or prior period activities. And, we got to watch that. It's just one among many mixed signals that the economy is throwing. Some, like this, suggest that the economy might have weakness under the surface, and others, like the inflation numbers in particular and the demand numbers for the most part, spending for sure, are suggesting that there's a lot of strength in the economy that's not being recognized, and that maybe the real danger is more inflation than it is job market implications of a declining economy. So looking further into the week, we get real information about the real estate market. We get information about retail sales. This is huge from the consumer perspective. The consumer is about 2/3 of GDP growth, so we want to see what's happening with sales. And that's expected to be flat. To slightly down, depending on the metric in particular that you're using. You look at it without auto and gas, and in another way, this control group. But they're trying to gauge what's really going on with the consumer. And sometimes, like gas prices being volatile, taking that out gives a smoother read of what's going on. In and of themselves, none of these numbers are actually too substantively different. They measure the same thing, and it's best to just look at them and say, what's the degree of change and what's the direction, rather than trying to say what is the implication of the expected 0.6% when in retail sales ex auto over month. That's less informative than is it declining and by how much, which we have here, and that is expected to show a slight decline. We get information about the real estate market again, and business inventories, which are expected to show a decline. And this one's interesting because what's happening with inventories could be a signal either that the economy is about to weaken or strengthen. Inventories are ordered based on retailers' sales forecasts at the retail level, and then they flow backward through the supply chain. So in one sense, if you see declining inventories accompanied by rising sales, that suggests robust economic activity. Whereas if you see, inventories that are going lower along with sales that are going lower, that means that businesses are adjusting to an overall lower expected sales cycle, which would be more indicative that the economy was expected to decline by some very informed, organizations. So you have to read that one carefully as well. But the big main event over the next couple of weeks is going to be the first meeting of the Fed under the new chairperson, Warsh, and all of the market participants are going to be keenly watching this one to gauge what the messaging is going to be like under the new regime, and also, are they going to be tough enough on inflation, which is a real concern in this market right now. We'll get information on the labor market, and here we get more demand forecast kind of metrics in terms of the Purchasing Managers Index. We'll get core PCE, the consumption and expenditure indicator. That's the preferred metric of the Fed, which is expected to come in at 4.1% year over year. It's less informative than to look at that at month over month. Month over month was still growing by 0.1% to 0.5%. And that's a large number. That's a number almost getting near like 5.5%, 6% when you annualize that number. And that suggests very high, consumer inflation, which is unhealthy for the economy and unsustainable. The Fed is going to be, if these numbers bear out the way they're forecasted, they're going to be evaluated what they did, this week at the meeting, at the rate decision, and say, is that enough to keep this inflation under control or reined in? Because as of now, it's clearly expected to be growing. And inflation expectations drive actual inflation. And commodity prices have been, used as a proxy for inflation in the real world, not just conceptually in terms of expectations, for a very long time. And those numbers, those indices are all trading at, very high levels relative to where they were a year ago. So inflation's already a concern. And, as we look over here, we see signs that analysts are starting to be concerned about it because they're expecting higher, not lower inflation. And we'll round it out with some sentiment indicators. Now, crude oil has come down pretty dramatically over the past 24 hours since that accord was signed. But is that really durable? We don't see a return to this world that existed where we were down here, a year ago and more, where oil was down around 60 for a good while prior to this. And then now we have this world where shipping rates and insurance costs are going to be materially higher for the foreseeable future, truce or not. And that's if the truce was going to hold. We're not even convinced that's the case. It doesn't look great on paper when you read through the finer points. It doesn't look like it accomplishes very much except stopping the fighting. But should the hostilities over there be truly over, there were damages to facilities all throughout the Gulf, major producers of liquefied natural gas and oil that have been shut down that are going to take months to years to come back online. So for everyone that's out there kind of expecting oil to fall off a cliff, this has apparently fallen off a cliff. But there's going to be a floor for it that's substantially higher than down around the 60s where it was before, just due to the shipping costs, just due to the constraints of lower numbers in terms of supply, because those damaged facilities were significant throughout the Gulf. So we're not really convinced that this oil is going to keep coming down, certainly not back down to the 60s. This is the interest rate probability function in Bloomberg, and it essentially gives us positioning in short-term interest rate futures that can give us a good idea of what the probability is of rate hikes or cuts. And as you look across the next year, we have probabilities that are positive for a hike. And in fact, once we get through January through March of 2027, we see at least one rate hike. And if the Fed is going to be doing its job properly with inflation, their own preferred metric, the headline number being 4%, we'd expect them to cut Wednesday if they were doing it right. But we're going to wait and see. Moving on from that to the S&P 500 index, we're trading basically approaching the all-time highs, largely on this renewed idea that there's going to be peace, so it's safer to invest. But again, that's a tenuous idea. We'll talk about it again some more. Volatility has come down sharply from even last week. Down to 16 on the VIX means, much lower day-to-day swings are what the expected environment holds by some rather sophisticated investors. This is based on, options activity on the S&P 500. So this suggests a lower volatility period may be ahead of us for the next 30 days, although, again, we're not entirely convinced of that. Looking at rates, the Treasury curve is kind of interesting looking at the 1 to 2 year, having a pretty extreme slope. Not really sure why that is, but we have further out than 1 to 2 years. Clearly, inflation, which is the main pricing component of Treasury bonds and yields, is up. If we take from February 27th, when we started this adventure over in the Persian Gulf, rates are up pretty substantially. 0.5% on 10-year paper, 33 basis points on 30. These are big moves, and it's likely that this, again, sophisticated investors are making those yields go to where they are because they're demanding that yield to compensate for expected inflation. So corporate bonds, we have 4.5%, 5% out on the curve. If you go out past 20 years, you're getting close to 6%. That's great for fixed income investors. The idea here is we used to live in a world where, Some portion of the portfolio was in stocks, some portion was in bonds. The traditional 60-40 portfolio, which some of the pundits have in recent years said was quote unquote dead, which is now in vogue again because we've returned to a higher interest rate, higher volatility environment. And long term, corporate bonds have lower volatility, and when you add them to a portfolio, it lowers the risk of that portfolio. And when you're getting paid 5% or so, 4.5%, 5% in yield to protect your portfolio and have lower volatility, it just seems to make sense to us, and we like to do portfolios that way. It's certainly working in this environment. Coming back to it, here's the long-term S&P 500, and before we go through a review of that, the longer term, the past 20 years, let's talk about what happens, what are the risks around this memorandum of understanding that happened. Well, it's kind of vague in terms of what it actually accomplishes, except for a cessation of hostilities. The overarching goal that was explicitly stated by our people in the States was they wanted to have control of the Iranian uranium. They wanted to have certitude that the country could not possess nuclear weapons, and they need the Strait of Hormuz open. Well, so in the short term, during this truce, the Strait of Hormuz will be open, but it isn't clear that Iran isn't going to try to charge tolls or do other things that might be considered to negate the deal by our side. So there's that. They're also now negotiating during this 60-day period established under that memorandum as to the status of their nuclear program, which, is a bit of a head scratcher when our explicit goal for all of this was to make sure that there was no retention of nuclear material of that nature. And now we're negotiating about it. So we think that there's a lot of potential wrinkles. And what would happen if the deal falls apart and renewed hostilities come? Well, we're going to see a quick flight to quality. We're going to see a risk-off market again, and the odds of that are pretty high. With that said, if the peace holds, that's a very beneficial environment. We can start healing our energy market infrastructure, and we can start, moving forward into what the new geopolitical reality is going to look like. That's certainly not going to go back to status quo from the 10s and the aughts and the 1990s, the globalist era. We'd like to see what that stabilizes into under more quote unquote normal conditions that don't involve conflict. But over the long term, despite drawdowns, let's say that this memorandum falls apart, we see a market, correction. Here was 2008, the crisis we all thought was going to end the markets as we knew it, the financial system. 2018 was a bad year. 2020 was a very bad year. 2022. And even, there was a nice drawdown about a year ago, a little over a year ago, and to start the year off as well. But if you stayed invested and you didn't panic out at any of these events where it seemed terrifying and you stayed to your long-term plan, you've done just fine. And that's what we advise clients to do. So, first off, hope you found the video useful. And if you have any questions about your portfolio or what's going on in the world and how that implicates, what you need to do in the investment plans that you're in, feel free to give us a call. We love to talk about it. Thanks and have a great day.